Wonderful. Well, from your perspective, are there any CMBS-backed asset classes, excuse me, that you feel are underrated or overrated, and which ones?
Yep. It's a very interesting question, and the answer is probably not a very obvious answer. One of the biggest frustrations for me, coming from a new rating agency that's been trying to break into the business, is this notion of investment charter guidelines. A lot of institutional investors have investment charters that have very antiquated guidelines because they were written when there were only two rating agencies in existence, Moody's and S&P.
And I'm sorry, how many are there now?
Now there are six active NRSROs in the CMBS space.
Okay.
So these guidelines stipulate that a lot of the institutional investors that buy the senior most rated debt have that debt rated by either Moody's or S&P or both of them. Some of them include Fitch in the mix as a major. So, as a lot of people know, S&P was sanctioned by the SEC and they were precluded from rating CMBS conduit deals for a year. So they have sort of been on the beach. During this time, the AAA and AA bonds, in order to maximize their liquidity, both in the primary market and the secondary market, need to have a rating from a major. The only major out there to do that now is Moody's. So this sanctioning of S&P has given Moody's a virtual monopoly at the top of the capital stack for conduit deals, CMBS conduit deals.
Interesting.
And what it's enabled Moody's to do, in my opinion, is pander to the regulators and protect themselves from potential liability by coming up with a very, very, very conservative position on credit enhancement, which in many instances may not even be consistent with where they are in credit enhancement on legacy deals. So if you're asking me about underrated, I would probably point to some of the senior tranches of new conduit deals that carry Moody's ratings at the top, assuming that those are the ratings that the deal carries.
Got it.
Deals that are probably overrated are deals in the single borrower space, less so in the conduit space. And here is a situation that's also sort of the result of rating agency criteria, guidelines, and, from a cynical perspective, probably a little bit of competition. Two rating agencies, S&P and Morningstar, have changed their criteria to use cap rates in valuing real estate assets in CMBS deals that are more akin to actual cap rates that where properties are trading in the open market now.
Sure.
Traditionally, all of the rating agencies typically employ cap rates that are about 200 basis points north of where actual cap rates are, because one of the things that rating agencies need to be cognizant of is the notion of ratings volatility. Investors that are long rated bonds are not only concerned about defaults and losses, they're also concerned about downgrades.
Understood.
And so the use of market level cap rates has enabled certain rating agencies to come up with higher property values than other rating agencies, which in turn enables them to come up with a higher level of rated proceeds for some of these standalone transactions.
Okay.
So I think there are probably certain single borrower transactions out there that if we were rating them, or if some of the other rating agencies were rating them, they might actually be rated less favorably.
Got it. Yeah, very interesting.